Good morning, ladies and gentlemen, and welcome to the Premier Miton Global Renewables Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, if I may, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Fund Manager James Smith. Good morning, sir.
Good morning. Thank you very much, and thank you everyone online for joining us this morning. So my name is James Smith. I'm the manager of the Premier Miton Global Renewables Trust. And a slight bit of background, I joined Premier in May 2012. Prior to that, I was part of the team at Utilico, mainly on Utilico emerging markets. So I have a long background in infrastructure, utilities, and renewables investment. So I just echo that I encourage questions throughout. So do feel free to pose a question, and we'll try and answer as we go, but with time for Q&A at the end. So let's just move on. So the management team here at Premier Miton. So I am part of the infrastructure team with my colleague Jim Wright, and he runs Premier's open-ended global infrastructure fund. Of course, the Premier Miton Global Renewables Trust is a closed-end investment company. So those two funds constitute Premier's infrastructure desk. Claire Long is our head of investment trusts. So I think she's on the call today, so if anyone has any questions for her, feel free to submit them as well. And then we also have Helene Winch, who's our head of responsible investing. This is not an ESG scored fund, although of course focuses on renewable energy. So of course the Premier Miton responsible investing team pay very close attention to what we are investing in and making sure that we keep to our published mandate. So just a quick overview of the trust. It's a relatively modestly sized trust, but I think perfectly formed, give or take 47 million sterling of gross assets. We pay a dividend yield of about 5%. We pay 4 dividends per year. Currently, the dividend is 1.85 pence, which we will pay at the end of June, so 1.85 pence per quarter. The share price is give or take £1.40. We aim for both income and also capital return. And we invest in, as I said, the renewable energy sector and other sustainable infrastructure investments. So when we say renewable energy, we are coming at it from an infrastructure point of view rather than a technology point of view. So just to kind of put an overlay on this, why do I think it's a good idea to invest in renewable energy? Well, there's been quite a number of changes over the past 10 years, but the biggest one is a constant underlying fall in cost. So, of course, as we have more renewables and we get better at building them and they become bigger and more cost efficient, the costs have come down such that they are now the lowest cost form of electricity generation. So we've gone from a position whereby in the early days they needed a subsidy, and of course a lot of those subsidised assets still exist running through those fixed term subsidy periods, to now actually renewables in Europe have been subject to windfall taxes because they're making very good returns in a competitive electricity market, and they're being the lowest cost producer. The government deems that they're actually making windfall profits last year. So I think that's quite an interesting and very healthy change. It's much better to be the lowest cost producer, and governments perhaps thinking, well, you're making too much money, than being the highest cost producer and needing a subsidy in order to be competitive. Number two, and this has really been in the news a lot over the past couple of years with what's going on in Ukraine, of course. And that's renewables are a secure domestic source of energy. So every megawatt hour of electricity produced from renewable energy in the North Sea or solar farm or whatever it is 1 megawatt hour of electricity that doesn't need to be produced with imported gas. And that does mean that, as a country, you are less subject to the vagaries of global fossil fuel prices, for instance. Thirdly, low correlation to gross domestic product. And what I mean by that is because renewables are zero marginal cost, so every additional unit of energy doesn't actually cost anything to produce, they are what we call must run. So the grid operator will always buy power from renewables if it's being produced. In preference to technologies such as gas generation, for instance, that have a marginal cost associated with them, and also a carbon cost. And what that means is if demand falls because gross domestic product falls, such as in 2020, and electricity demand is lower, it is those other technologies which will see a reduction in their output rather than renewables. Renewable output is really only subject to the vagaries of the weather. Number 4, we'll come on to this in a bit more detail, but exceptional levels of growth. So we'll put some more flesh on those bones in a moment. And then, of course, number 5, renewables are a very important element in the fight against climate change. Now, I always say there are a couple of reasons you could make a case to invest in this investment trust. One is climate change, ESG factors, and secondly, that it's simply good economics. I will focus this presentation more on the economic aspect, but it's important to bear in mind all the environmental benefits as well. So what do we actually invest in? So this is the company's segmental makeup at the end of April, and the main categorization that we use for renewable energy companies, they fall into 2 distinct flavors, and it's important to understand what these are. So firstly, we have what I refer to as yieldcos and funds, and these are companies that their business model is to buy either operational or close to operational, like in construction, renewable energy assets, and then own and operate them for the duration of their economic life. So they tend not to go through what we call the development process of finding a plot of land, doing a wind study, getting planning permission, getting permission for a grid connection. All that can take a long time. So these companies don't bother with that. They just buy the asset once it's built. And the benefit of that is that all your capital can be put to work in revenue generating assets at any one time. So those companies tend to have high dividend yields and high cash flows. And in the past, if they've wanted to buy new assets, they've tended to issue new equity rather than use retained cash flows. Now, as it happens, they're all making very strong returns. So they're seeing increasing levels of retained cash flows over and above the dividends they pay. So perhaps there might be slightly less of a need for equity in the future. But that's the yieldcos. And you may be familiar with some of these names, such as Greencoat or Bluefield Solar. There's a number in the UK and Europe. There's a number in the States. And we consider them to be part of our investment universe. They're not competing funds because, of course, this fund is investing in listed equities, whereas the yieldcos are investing in physical projects. The next large category for us are the integrated renewable energy development companies, so renewable energy developers. So these are the companies that go to, through that lengthy process of designing a renewable energy asset, going through all the permissions, the environmental permits, building it, and then operating it for its economic life. Now, in order to raise the capital to do that, they would tend to use more retained earnings, but they may also sell projects or stakes in projects to the yieldcos or to other financial investors such as insurance companies. So those two are the kind of core renewable energy companies. They are, I think, 70%, give or take, of the total portfolio. And then below that, we have a mixture of other things. So 10% being renewable-focused utilities, and that would be stocks like SSE, for instance, or NextEra in the States, or Iberdrola in Spain. So so utilities with a large proportion of their earnings coming from their renewable energy business. To make it investable for us, it would have to be at least 25%. But if you look at the value of a company like SSE, it's quite a bit larger than that in their renewables business. And also, it's important to understand that many utilities are seeing very strong asset growth because of renewable energy. So we're going from a system whereby a country like the UK may have a dozen, maybe slightly more, very large power stations, or fossil fuel or nuclear or whatever they are, to a system whereby we have many thousands of smaller power stations. And that means more investment in the grid, more transmission infrastructure, more distribution infrastructure. And then carrying on from there, we also invest in energy storage, so mainly battery storage, biomass generation. I know that can be slightly controversial to some people, so we can discuss that in more depth later. And then renewable technology, we also have a little bit, just in a couple of small positions there. Moving on to where we invest. So we are quite overweight in the UK. I should start actually by saying we don't follow any particular index. For performance comparison purposes, we use the S&P Global Clean Energy Index, but we don't use that as an aid to portfolio construction. So our geographical makeup is going to be quite different to any renewable energy index you might see. So UK, just over a third. The UK is a very advanced renewable energy market, and actually we have a very strong natural advantage in renewable energy. So the North Sea, for instance, and the Irish Sea are both relatively windy and relatively shallow, which is of course a very good environment for offshore wind, for instance. Europe, about 30%. Again, Europe certainly at the forefront of renewable energy development. Global, 21%. Now, global means those companies that are operating all over the world. And there's a number of renewable energy stocks in the portfolio that are doing that. Good examples, for instance, would be Northland Power, which has 3 offshore wind farms in the North Sea. It's about to start building offshore wind farms off Japan and Taiwan. They're developing a project off Poland. So they're operating all over the world. 7.5% in North America. That would normally be a little more. There are a few peculiarities of the way that renewable energy is sold in different places. So in the UK and Europe, there are proportionately more market-based revenues. Let's put it that way. So renewable energy takes a kind of market risk. There's active power markets. Whereas with North America, you tend to find renewable energy assets selling all their power over fixed long-term periods, 15, 20 years, but at relatively fixed prices. So as we've seen interest rates going up, the North American renewable sector is more of what I term as a bond proxy type investment risk. So not necessarily going to perform particularly well when in a high interest rate environment or when interest rates are increasing. So that's the reason why North America is fairly low. But the operational environment there is excellent. We've got the new Inflation Reduction Act, very strong levels of growth. So I'd expect to see that North American weighting increase over time as interest rates begin to level off. We have about 2% in China. That used to be quite a bit higher. We did very well in China in 2020 and 21. Not quite so well in 2022. But we looks like we're going into a sort of higher risk environment in China recently. So that's only about 2%, and then about 2% in Latin America. So it's predominantly a developed market portfolio. but with a small weighting to emerging markets. So let's take a little overview of the renewable energy opportunity at a higher level, and just try and understand where the growth has come from and what we should see over the next few years. So I always like to think of it in that there are three legs to growth in renewable energy, and we are just getting started on the first leg, and the next two legs will really drive growth as we go over the next 30 years. 2050 is often used as a rather arbitrary date for net zero, but in order to achieve net zero, we're going to have to see a huge growth in this sector. So the growth that we've seen over the past 10 to 15 years has come from this first part, where renewable energy generation has come as part of the electricity generation mix. So renewable energy assets have displaced fossil fuel generation, such as coal in the main and also gas. But that can only take you so far. So if we look across the world, only about 20% of total global energy is actually consumed in the form of electricity. And if you think about your own lives, most of the energy you use in your daily life, probably you're heating your home still with gas, driving to work with a fossil fuel powered car rather than an electric car. So only about 20% of total energy is in the form of electricity. So in order for renewables to grow beyond the electricity sector, what we need to see is this second growth leg, which is the growth of electricity as a fuel of choice. So in the Western world, over the past 20 years, electricity volumes have been falling. And they've been falling because we've become more efficient over time in the way we use electricity. So, of course, lighting, but any electrical appliance, industrial usage is becoming more efficient. Now, over the next 30 years, we should start to see electricity actually growing quite strongly as it becomes a fuel of choice. So, for instance, electric vehicles would be the obvious one, but increasingly space heating, both commercial and domestic. So, heat pumps, of course, I have a heat pump in my house, which works perfectly well. Of course, there are challenges retrofitting to older houses, but for commercial space, we should start seeing more electrical heating rather than fossil fuel. And then, of course, light industrial. But then the big kicker is going to come longer term through the use of hydrogen. Now, of course, we already use hydrogen quite a lot for production of fertilizers and also in the oil refining industry. And that hydrogen is manufactured from natural gas. But hydrogen can be made from electrolysis of water, so splitting water out into its components of hydrogen and oxygen. And then that hydrogen can be used in industrial processes, and those harder to decarbonize, harder to electrify areas such as heavy transportation, such as trucks, sea freight and air. Now, I don't think you'll see battery trucks, but you will see trucks using hydrogen, and you'll see sea freight using an ammonia-based synthetic fuel produced from hydrogen. So that's the way that renewables will expand beyond the electric generation mix. So just continuing with that, and I mentioned that renewable electricity is only about 20% of total global energy usage. But if we look at what we refer to as primary energy, so natural energy. Now, of course, electricity is not a primary energy. Electricity has to be manufactured. It doesn't exist in a natural form outside of a thunderstorm, which isn't really something that you could utilize. So if we look at primary energy, how much of the world's energy is currently in the form of renewables? Well, it's only about 7%. So the world is still very much a fossil fueled based energy system. So you can see that renewables, if we are going to get to net zero, are going to have to increase a multiple times from their current level of penetration. So there's a lot of growth ahead of us as renewables replace coal and oil and natural gas. Now, coming back to electricity, and I mentioned earlier that renewables are now the lowest cost form of power generation. So just to put some detail onto that. So when we trade power in the markets, we trade it in terms of megawatt hours. So that's 1 megawatt of production for 1 hour. And renewable energy production in the UK is around 40 to 50 pounds per megawatt hour in terms of cost. If we look at gas, combined cycle is currently around 100 to 120. No one really knows what nuclear costs, but large new nuclear is very expensive. The blue bar on the right there is showing the average electricity price so far this year. So this is why the government have been, thinking about windfall taxes, because the cost of new renewable energy, so this is for new build, is so much lower than the electricity market, which is leading to very strong returns in the sector. I've got a couple of questions come in. One about buybacks. We'll put that to the end when we're just discussing the trust in the round. But question, just going back to the slide a moment ago on our geographic exposure. So the question is, we don't have any exposure in India, and why is that? Well, that is true. This trust has had exposure to India in the past. What I would say is it's very difficult to make money in India. Very difficult to make money in the renewable energy sector. A number of companies have tried and failed. There is a listed stock in America, actually, which is a pure play, quite large, actually, renewable energy company called Azure Power. And if you look at their returns, they're very low. So the sector in India has been largely the local distribution utilities holding options for solar parks to come and connect to their network and receive a fixed price. And the returns have been very low. It's been very competitive, and no one's really made any money. So until we start seeing improved returns and slightly improved risks, I don't think you'll see us in India. So just going back to growth, so if we go back, looking at global renewable energy production over the past, I think it's 12 years, the growth has been 15% per year. And bear in mind, this is just within the electricity generation sector. And if we look at renewable generation as a part of the electricity generation sector, it does vary wildly wherever you are. In the UK, it's over 40%. In Europe, it's getting on for that level, slightly lower. In Asia, it's quite a bit lower still. But across the world, maybe 10 to 15% of electricity is generated from renewable energy. So there's still a large growth dynamic as renewables expand within the electricity sector, and that's been 15% per year. And you can see there's a good mix there. Wind still is actually the main renewable generation technology across the world. The pale blue bar there is solar, so that's been higher growth recently. And biomass is more important than people think. People tend to ignore biomass, but across the world it is quite a significant renewable energy production technology. Actually, yeah, we've got the figures here. So if we look at renewables as a proportion of global renewable energy production, 12.8%. This is from I think this is the BP figures taken from their report last year. So you can see that that could quite easily double or triple over the next 10 years or so is what I'm expecting. Coal, natural gas, still the dominant energy production technology, dominant electricity production technologies. Now, I actually expect that that 15% growth in renewables that we've seen over the past 12 years is going to increase over the next few years. And the reason for that is if we look at new build renewable energy generation, so actually new build capacity, we've got both wind here and solar. So we're looking here at the actual amount of new capacity coming on the system globally. You can see that it's increasing. So not only is the total stock of renewable energy increasing, but the rate at which it's increasing is actually growing, particularly in solar. So that should lead to faster growth and more investment opportunities in coming years. Quick glance at the 15 largest holdings. Happy to discuss any of these in more depth. Now, you may well have come across a few of these, such as Greencoat UK Wind, 6.7%, and Next Energy Solar Fund. So those are two of the UK yield codes that we like. But what you can see, what we're trying to do here is give the investor a kind of one-stop shop for global renewable electricity production. So there's a number of companies here that you won't have come across, both yield codes like Clearway Energy in the States, global renewable energy developers like Acciona, or more specialist renewable energy developers like Bonheur, for instance, which is a Norwegian company. I think we've got about 42 stocks in the portfolio at the moment. Fairly concentrated. You can see about 40% or so is in the top 10. So yeah, we don't mind making reasonable weightings where we feel there is a strong upside. Now, the yield co-sector you can see is very highly represented there. There's a reason I like yield cos at the moment. So we've seen a global shift, and particularly in Europe, shift in shift in electricity pricing. So electricity is becoming more expensive. And the reason for that is that costs are just going up in all the other technologies. So in Europe, for instance, carbon price has gone up and is now a major component of cost for thermal electricity production. Of course, renewables don't have to pay that. So the more that the carbon price goes up, essentially that's just going to push electricity prices up and is a revenue to renewable energy generators. Of course, you've got higher gas prices in Europe. They've come down a lot, of course, but I wouldn't be at all surprised to see gas prices go back up as we go toward winter this year. I don't see the situation in Russia and Ukraine being resolved anytime soon. And in Europe, we've gone from a system that's very much reliant on imported, very cheap Russian piped gas to one that's reliant on internationally competitive LNG, so competing with China and Japan for those volumes, and also with a much higher infrastructure cost as well. So that will push electricity prices up. Now, the interesting thing about yield codes is, particularly the UK ones, they trade by reference to their NAVs. So they all publish a NAV. Interestingly, the US ones don't. Their accounts look more like just a normal company. But the UK ones publish a NAV, and they trade at a discount or a premium in the same way that Premier Miton Global Renewables Trust does. And at the moment, they're all at a discount, which I think is a good opportunity to buy. And I also think that the assumptions within those NAVs are too pessimistic, particularly for electricity pricing. So as electricity prices turn out to be much higher than is assumed within those NAVs, those share prices should trend up over time as those higher prices are kind of realized within the NAVs. So a quick summary, and then we can move on to Q&A. We offer a range of infrastructure technologies in renewable energy. So, we're happy to own wind, solar, biomass, whatever. Also other technologies such as waste to energy, energy storage, electricity networks where they're benefiting from renewables. And also try and find the hidden value of renewables within some of the utility companies such as SSE. We're not about taking technology risks. Many of the clean energy funds, such as Impacts, for instance, if you want that kind of technology play, you're probably better off investing in that. It's not something that we are trying to offer. And I think that's probably about it. So some key facts here if anyone needs to know about number of shares in issue, etc. The board. So that's it. So let's move on to some questions. I think we currently have a few. So firstly, would you consider share buybacks? It's a tricky one. This trust is if you want to go into more depth, we can do, but it's a split capital investment trust. So we have two classes of share. We have what we call zero dividend preference shares, and we have ordinary shares. And the zero dividend preference shares are the they are the highest ranking share. So if you're an ordinary shareholder, they effectively act as gearing. So if we were to buy back ordinary shares, the problem is then that increases gearing. And of course, the higher gearing you have, the more risk you have. So buybacks for us, I don't think are the right thing to do at this moment in time. Although, of course, I never say never. But I think, no, we wouldn't be buying back just at the moment. James says, the UK currently struggles to store large amounts of renewable energy with such a strong weighting to the UK. Are you seeing this impact the portfolio in any way? That is true. The UK doesn't have enough storage capacity at the moment. But I'd turn that on its head and say that leads to an opportunity. So several stocks, of course, we own some battery storage funds within the portfolio, and they've performed pretty well over the past 18 months or so, largely because storage is undersupplied in the market. But also there's a number of companies that also have storage like SSE, for instance, and also Drax Power. SSE had their March 2023 results out the other day. So if you take a look at those, you'll see that their storage business performed exceptionally well. And SSE and Drax, their storage business is in the form of pumped hydro. So it's slightly longer term storage than battery storage. So it's kind of not really there for short-term responsive storage, but more slightly, longer term storage. But it's been very profitable in this market. And both those companies are looking to expand those pumped storage hydro dams. So I'd kind of answer it in that way. So a positive impact. Michael asks, share register mainly retail shareholders, or do you have an institutional following as well? It's a mixture of both, but as a small investment trust, I think in common with other small investment trusts, what we've seen is that the wealth manager market doesn't want to invest in small investment trusts anymore. And that's perhaps one reason why we've seen discounts in that sector move out a little bit. So if we look at our register, we do have a few wealth management clients who have reasonable holdings, but the largest investors are the retail shareholder platforms such as Interactive Investor and Hargreaves, AJ Bell, for instance. So I think the institutional or wealth manager clients that we have, they like the story. They are all very long-term holders and supporters of the trust. But yeah, the marginal buyer has over the past few years been retail money. A question that was pre-submitted. Where would you identify the excitement in the portfolio? So firstly, I'd say I believe the portfolio is very undervalued. Now, a couple of things have happened over the past, if we look over the past 3 or 4 years, we had excellent years in 2019, 20 and 21. And in each of those years, the ordinary shares returned about 30% in each year. And then in 2022, last year, it was quite a difficult year. And then so far this year, we're also down, I think, about 7% in total return terms. So the past 18 months have been pretty tricky, but the prior 3 years were excellent. So what's happened over the past 18 months? Well, the big one, we've seen interest rates go up. And that's meant that any stocks with a dividend, particularly, are being kind of pigeonholed by the market as bond proxies. So they're not really seeing the growth in the sector in the same way that I see it. So I think the whole renewable energy sector is very exciting with high growth. Now, the other thing that's happened is over last year, power prices flew up very strongly, particularly in Europe, on higher costs. But so far this year, we've seen them coming down. So investors have kind of ignored the higher prices, are just focused on them coming back down. But what I would say is that power prices are still quite a bit higher than where they have been on average prior to the Russian invasion of Ukraine. So in terms of putting some numbers on that, UK power prices in the wholesale market are currently about £90 per megawatt hour, whereas in the run-up to the Ukraine invasion, historically we were used to seeing prices more like 50 to 60. So even though they've come down from their highs of over 200 and getting on for 300 back to a kind of more normal level, they are still very high in historical contexts. And I don't think the market quite understands that. And most of the renewable energy yield codes, for instance, are still assuming power prices over the long term come back down to that 55 to 60 level. Now, given where carbon prices are and the fact that we've seen this long-term structural change in the European energy market, which I don't think is going to go away, I don't believe we're going back to 50 or 60 pounds or euros per megawatt hour electricity. I think 100 is the new 50. And I think the market will realize that over the next 12 months. And I also think that perhaps we will start to see a plateau in interest rates and yields perhaps coming back down as we maybe go into a more recessionary or contractionary environment. And those companies that have been marked down when interest rates have been going up should hopefully see their shares recover when interest rates go down. Now, there is this difference between public markets and private markets. So we are seeing, I think, the public markets be very pessimistic on valuation, whereas the private markets are still pricing at a higher level. And we've had actually this very morning, a stock in the portfolio. It's a Spanish renewable energy development company. So they operate in Spain, but also in the States and a few other places in Europe, called OPD Energy. So the ticker is OPDE. And that's a stock, I think this morning, let me tell you. So it's a weighting of, apologies, it's 2.5% in the portfolio, 2.5%. And that's seen an offer for its shares this morning. So at a 47% premium to its share price that closed on Friday. So it closed on Friday at €4. And there is an offer out this morning at $5.85. So I wouldn't be surprised to see a bit more corporate activity coming into the sector. So yeah, I think there is maybe going to be more excitement over the next 12 months than the past 12 months. If that answers that question.
James, if I may just jump back in there, and thank you very much indeed for being so generous with your time there and addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the Investor Meet Company platform. But James, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Okay, yeah, thanks, Jake. I think over the next, giving a short-term outlook, which I think is what people are often interested in. Obviously, the last 18 months have been pretty tough for renewable energy, utilities, all those sort of things. I'm hoping the next 18 months might be a bit better. I think there is a strong likelihood that power prices will go back up as we get toward winter this year. And that should see, I think, the market coming back into these stocks. Of course, interest rates hopefully may have hit a peak. But there is, looking longer term, I've written an article on this recently. I think it's very easy to get distracted by short-term noise of power prices, interest rates, politics. The fact is, over the next 10, 15, 20 years, this sector is one that's going to see huge growth. And if I look at what the companies we own are actually doing, and if I look at their pipeline of investments, those pipelines are a multiple of their current operational capacity.
James, that's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Premier Miton Global Renewables Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.